What's up, everybody? Joe Brown here. This is the Heresy Financial Show, and you know I promised that as soon as I saw anything change in the housing market, I would let you know, and that is this video. Today is that day. We are going to be looking at the first bearish signs that I have seen in the housing market in years. Now starting to see some things that are a little bit concerning, but make sure you hang along until the very end because there is a big but that I am going to show you about the housing market as well. Make sure you stick around for that big but. Ready? Let's dive in. Today's sponsor is Masterworks. Masterworks, you've heard me talk about them plenty of times on this channel, and they are revolutionizing the way that the average everyday investor can invest in contemporary art. Again, this is an asset class that used to be reserved for the ultra wealthy because if you're gonna buy a Picasso, you're gonna have to fork over a big lump of cash in order to afford that. And if you're the average everyday investor, you might have to fork over your entire net worth to be able to do that. That is no longer the case today. With Masterworks, you can invest in securitized art. They take a piece of real art, these are not NFTs, this is not digital art, something like a Picasso or a Banksy, and they turn it into shares, they fractionalize it. You can buy shares of a piece of real contemporary art, and then you can even sell those shares later on their secondary market. They've got a fantastic track record with their net annualized return at 14%. They've got over 100 total offerings and over 400,000 registered users and $400 million in securitized paintings. You can see here these three recent pieces by Banksy, George Condo, and Albert Olin have all returned over 30%. They're extremely picky with the art that they choose, seeing that only 2.4% of works will pass their due diligence process. So how does it work? Well, first their research team chooses artists. Then Masterworks will purchase that painting. After it's purchased, they will securitize the painting while they file an offering circular with the SEC that allows anyone to invest. And then they hold that painting for 3 to 7 years. After investing, you can sell your shares to other members, which means that contrary to what has happened historically, through Masterworks, they are able to provide liquidity to paintings. And with the stock market so volatile today and other asset classes like fixed income and hedge funds and private equity having such a high correlation to equities and contemporary art having such a low correlation to equities, there is no better time than today to diversify your portfolio and get into contemporary art. Join 400,000 plus other members, registered users on Masterworks. You can skip the waitlist by signing up with my link in the description today. All right, so this is the first time in years that I have seen housing data come out that makes me think, oh, things could be turning around here. The first time I've seen some concerning data. So the first thing that we are going to be looking at is inventory. This chart from the Fed, obviously there are many different sources of this same data, but this chart is the one that many people are concerned about right now. We are seeing inventory spike. It is just accelerating very quickly here. If we zoom out, you can see that this is just a very quick spike recently with inventory shooting up to 9 months. What is this figure? This is the number of homes that are currently for sale divided by how fast homes are selling, and that comes up with your number of 9, saying at the current pace that houses are being sold, it would take 9 months to get through the current inventory. For the last couple of years, this number has been extremely low because there's been so little inventory that houses are just getting sold and sold and sold. As soon as something comes up on the market, it gets sold within a couple of days, couple of weeks. And so this number has been extremely low, saying, hey, if there's no new homes that hit the market, we'll get through all the for sale homes in like, a couple of weeks or a couple of months. Now that number's at 9 months. So we have inventory spiking in terms of months of supply, which means that houses are staying on market for longer and less people are buying, more people are selling. We're seeing 9 months worth of supply right now, and that number's changing quickly. Inventory's going up fast. Second thing is that home prices are still going up. You're going to see why this is included in the bearish case for real estate right now. We are seeing housing prices are still soaring. The median price of a new home in April was $450,000, which is 20% higher than April of 2021. So home prices are still going up, and that is pricing out buyers from the market. That is contributing to the inventory going up. But it's not just home prices still going up that is contributing to the inventory, contributing to homes not being sold. It's also the fact that mortgage rates are still going up. We've obviously had a recent little dip here because of what interest rates have been doing, but you can see this massive spike, historically speaking, in mortgage rates, and that has contributed to a massive increase in the cost of purchasing a home. If the price has gone up and interest rates have gone up, that means your principal and your interest portion of your payment is going to be a lot higher. Just in the last couple of months on the same home, you've seen a payment go from something like $1,500 per month to $2,100, $2,200, $2,300 per month on the exact same home because the average prices have gone up and the interest rates on the mortgages have gone up. And so we are pricing so many buyers out of the market right now that you just can't afford, especially these higher priced homes. And then finally, they're all kind of tied in together, looking at things from the same, from different angles, but sales are tumbling. If we look at newly built homes, sales tumbled 16% in April. And so of all the new homes that are being completed, sales of those homes are dropping very quickly. Part of that is because of how expensive they have gotten. The median U.S. new home price divided by the median U.S. household income is higher than ever. This chart goes back to 1967 here, and we can see that the price of homes has continued to go up relative to household income, and this is new homes. This is again because the prices have gone up and interest rates have gone up, and so the price of those payments is going to go up faster than incomes on average have been going up. And now for the big but. We are going to take a look at all of these bearish arguments and see if they hold water. We always want to look at all sides of the argument, make sure that we're being rational about the way that we're approaching this. So let's take a look at inventory. This chart you can see from tradingeconomics.com shows the total inventory of all homes for sale across the nation. And we can see here that yes, inventory is spiking, but in terms of relative to history, that's not really considered a spike yet. So at this point, you're probably asking, but wait a second, what was that other chart then that we just looked at that showed inventory was spiking? We were looking at this one, which is measuring inventory in terms of how many months it would take to get through the current supply. So today, if all the buyers dried up and literally everybody stopped buying homes, you didn't have a single sale take place from this moment forward, if you only have one house for sale, it's never going to sell. That means inventory is infinite in terms of how many months it would take for all of the inventory to get worked through. And so when buyers drop off of a cliff and demand goes to zero, that month's supply number is going to spike. So obviously you're going to see a spike there. So what we are seeing right now, looking at total inventory, we are not seeing panic selling. We are not seeing everybody list their houses on the market right now. In fact, we are seeing a very little change in new listings. What we are seeing is demand drying up. Nobody can afford homes right now. Interest rates have gotten too expensive, especially with the still rising prices. So nobody can afford. That means demand is going basically to not all the way to zero, but demand is dropping off really quickly here. So we're not seeing people panic selling. We're not seeing a massive increase in people selling like we saw in 2007, 2008 when inventory new listings were just way up here. We are seeing a seasonal spike in inventory here like we always do every year, but we are not seeing anything abnormal. What we are seeing is lower demand. So why does that matter? Well, it matters because we are not seeing panic selling. We are not seeing forced selling. We are not seeing a bunch of people forced to put their homes on the market because they're underwater, because they can't make their payment. Right now, the only people selling their homes are the ones that are trying to capitalize on timing the market and selling at the top, which they probably missed it by a couple weeks, maybe a couple months. So they're going to get discouraged. We are starting to see more and more of an uptick in prices being reduced. We are not going to see a massive wave of people panic selling here. In fact, if homes sit on the market for too long, what we are more likely to see is people taking their homes off the market. If you think you should be able to sell your house for $700,000 because your neighbor did 2 months ago, and now you list it for $700 and you get 0 bites, you drop the price to $680, you get 0 bites, you drop the price to $650, you get 0 bites, and maybe you think, hey, well, I only bought this house for $600, I don't want to go much lower. You're not being forced to sell. You very well may likely pull that house off the market, considering, again, you have to live somewhere. So if you sell that house at $640 and then you go and move somewhere else, your interest rate went from 3 or 4% to 5 or 6%. And so you are increasing your cost even if you are going to buy a house that is lower priced than what you currently are selling your house for. So this lack of demand at current prices and current mortgage rates could very well lead to, it's like a battle right now between the sellers and the buyers. No buyers are coming in, but the sellers have a lot of equity. The sellers have great credit. The sellers are not being forced out. They're not being foreclosed on. They're not underwater. And so they're just going to sit tight because sellers have to live somewhere. And so you're going to take that into account. You're going to say, hey, well, if I sell at too low of a price, well, then I'm going to actually lose money considering what I have to move into. And now you're thinking, okay, but wait, what if they don't sell and buy something else? What if they sell and then they go rent somewhere? Well, you still have to have somewhere to live. So that's going to still create a floor underneath the housing market from investors holding rental properties. And the other thing about rental properties is companies. Hedge funds, these massive corporations buying up entire properties, entire lots. They weren't buying these over the last 2 years to sit on them and hold them for 6 months or a year. They're off the market forever. And if Zillow sells a big block of homes, they're selling them to Invitation Homes. If hedge funds who bought up large blocks of homes so that they can rent them all out decide they want to exit that market, they're going to sell that entire block of homes to another company that's going to keep them as rental homes. For the most part, they're not going to be entering the market again. These aren't going to be going to retail investors. They're not even going to be going to homeowners, individual homeowners. They're just going to sell the big block of homes to another company. And you think, okay, but what about all of the home builders that are building a ton of homes right now? Because that's true. We've seen a spike in housing starts. Take a look at this chart from Joey Politano. We can see that, yes, housing starts have been increasing at the same trend that they've been increasing at since 2010, but housing completions have stagnated. They've moved sideways. Housing completions have not kept up. And now that we are seeing demand drop off, we are seeing home builders back off from starts. And so we are seeing a dynamic still at play where there are more people than there are places to live. But the people who want a place to live are right now being priced out from buying a place to live, so they're renting. That's why lower priced homes are still going hot. They're still selling quickly. It's the higher priced homes that are slowing down. So put all this together, what do we have? Very likely we are at a temporary top. Very likely, housing market's been going like this. We are topping out and we could drop 1%, 5%, even 10% over the course of the next year if everything stays the same. Absolutely, that could happen. However, for the housing market to drop 20%, 30%, 40%, something so catastrophic would have to happen. Number one, you'd have to have a massive wave of unemployment because there's so much equity. People's incomes have been going up, even though they haven't been going up with the pace of new home listing prices. Everybody who bought a house within the last 10 years, 5 years, 3 years, their mortgage payment, their house payment is staying the same and their incomes have gone up. And so in order to have a big wave of foreclosures, you need a big wave of unemployment. You need everybody getting laid off. You need everybody getting fired, and people can't afford those payments anymore because they're not underwater. They've got a ton of equity. And so you need to have a massive wave of layoffs and unemployment, which means that for something like that to happen, somebody big is blowing up. A big hedge fund, a big bank, a large corporation. Basically what I'm getting at here is we got another bailout coming. If something like that starts to happen, there's no chance We've got a snowball's chance in hell of the Federal Reserve and the federal government just rolling over and saying, hey, we will let a depression roll through our economy. Instead, what they're going to do is they're going to bail it out again. We know that's what they're going to do because that's what they've done every single time for decades. Anytime something crazy happens, they stop the depression, they stop the recession, they stop the crash from happening. And for a crash in real estate to happen, something else even larger and quicker would have to happen first, which means that if you want to try and time this thing, it's possible over the next couple of months, you'll be able to find a deal. It's possible prices will come down. If you wait too long and you aren't already in the real estate market, you might be priced out of the real estate market forever. There are a lot of people who have been waiting for the dip, waiting for the next crash, and are now priced out. And now they're stepping back and saying, well, I can't afford anything now. I was waiting for the crash that never came, and now prices are higher than I can afford. So they're waiting for things to crash, waiting for things to dip, and they'll get back in. They'll get in. But for the ones who don't, we are going to skyrocket. Next time something crazy happens, the Fed will step in, the bailout will happen, interest rates will get pushed down to zero. They're going to come out with a 40-year mortgage. They're going to come out with more first-time home buyer assistance, down payment assistance federally, and that's going to shove housing prices right back through the roof. And anybody who doesn't, in my opinion, get into the real estate market with anything, whether it's a cheap home, an expensive home, an investment home, something, at least getting your foot in the door, anybody who doesn't will be priced out of the market forever once it starts to go back up. So in my opinion, we've got at most a year to get in. We've got some deals coming up probably, but maybe you don't want to try and time the exact bottom because somebody could blow up tomorrow. Somebody could blow up next week. Somebody could blow up next month. The bailout could happen at any time, depending on how big the risk is pent up in the system right now. We just don't know how big the risk is. So in my opinion, better to be safe than sorry. At least get your foot in the door. And yeah, over the next couple of months, it's very likely we see some deals. And for anybody who doesn't get in, you may never be able to get in at all. That's what I'm seeing in the real estate market right now. As always, if anything changes, I'll let you know. Just like I said, this is the first time I've been saying, hey, I think we have a chance for housing prices to come down. I've never said that before. Now the data has changed. Now we're looking forward, and it looks like, yeah, we actually might have a dip in housing prices. I'll let you know if I change my mind. If the data changes, if the new data that comes out next month or the month after is wildly different, I will keep you updated. As always, really appreciate you guys. Thank you so much for watching. Have a great day.